So what do these sectors tell us about the outlook for the U.S. economy? Joining us now to connect the dots, Millan Mulraine. He's an economist at TD Securities. And welcome to Nightly Business Report.
Thanks.
So housing, retail, autos, they've been strong for the first 6 months of this year. Do you see that trend continuing for the rest of the year? Or is the second half going to be different?
Well, I think it's going to be different. It's going to be better. I'm fairly encouraged by what I've seen in the first half of this year. And I think there's every indication from what we've seen so far that the pieces are in place, the fundamentals are in place for us to have a more sustained recovery in the second half of this year. Keep in mind what we are seeing in the first half. The tepid recovery is a function of the significant fiscal austerity that we've seen. We've seen the biggest drag from fiscal austerity since the peace war period. And that's happening at a time when the economy is still growing at 1.5 with fiscal drag of 1.5. So the economy, or the fundamentals of the economy, are showing that we are having an economy that's growing at about 3% rate. And with that in place, as the drag dissipate in the second half of this year, you're going to see the private sector fundamentals start reasserting themselves. And then we could see growth north of 2.5% in the second half of this year.
If that prediction comes true and growth accelerates to 2.5%, maybe even more as we get into the fourth quarter, what is the implication for interest rates and the Federal Reserve's policy?
Well, that's a very interesting question. I think at this point, what the Fed has signaled that their intent is to start reducing the level of stimulus.
Right.
And I think they're looking at three things. For one, they want to see the confirmation in the economy that we are making a turn for the better and the pace of the recovery is accelerating. I think they will get confirmation of that. And that certainly means that the September timing that the market seemed to have priced in seemed appropriate at this time. So at that point, I think the Fed will get the indication that the economy needs less support, and they would start reducing the level of monetary stimulus they provide into the economy.
So how does all of this translate for people who are out of work and looking for a job? Do you think the job market is going to be better?
Yes, I absolutely think so, and there are a number of reasons for that. One is, I think the problems that we've seen and the tepid pace of recovery we've seen in the labor market more generally has a lot to do with the uncertainty. Political uncertainty, global uncertainty, and at this point, I think it's uncertainty about the nature of the recovery and demand. When businesses get more confirmation that there's a more sustained upward trajectory for consumer demand, then they will be more willing to hire on a permanent basis. And I think they would also be more willing to invest in capital equipment. And we are likely to see that starting in the second half of next year.
That's been a notable weak spot, hasn't it? Investment in capital equipment recently.
It absolutely has been. And again, I think they kind of go hand in hand, employment and capital investment. And to the extent that we've had some clarity on the political front, the next big step is to have that confirmation of sustained growth.
Let me turn you to housing, if I might. You think that the Fed may begin to withdraw some of the stimulus at its September meeting, or at least indicate that they're going to dial it back from, what is it, $85 billion a month now to something lower than that. The housing market has been dependent in part on very, very low interest rates. They've already ticked up. What do you expect that's going to do to the rate of growth in house prices?
Well, I think it would slow the rate of growth, but we would still have growth. I think the problem with the housing sector, and the initial problem, wasn't necessarily the fact that rates were high. The problem was the flow of credit. Banks were unwilling to lend. And people that were sitting on the sidelines were willing to engage in a sector where they think that over the next year or so, they would have capital losses. That has changed. The dynamics in the housing sector has changed. And with prices being on a more sustained upward trajectory, I think that would encourage potential home buyers to move into the market and encourage financial institutions to extend mortgages. So,
Good. Well, Millan, you've been giving us pretty much an upbeat report card for the rest of the year. Anything out there that worries you that could go wrong in the economy?
Well, I think the big factor for me is political risk. And as much as we've seen a lot of clarity on the political front with the tax deal that we had earlier this year, and we know for sure that sequestration has gone through, I think the next big thing for the markets and for the economy more generally is what happens in September, October, when we have to get a budget deal done. If there's the risk of a government shutdown, then I think that would possibly delay investment and hiring decision. Similarly, if we do have the government breaching its limit, the debt ceiling, hitting the debt ceiling without it being raised, I think that would also increase some volatility in the market.
All right. Lots of good information. So good of you to come by. Have a happy 4th of July.
Thanks for having me.
Thank you very much.
And that's Millan Mulraine, economist at TD Securities.